Hi, everyone. John Fitzgerald here. Just wanted to say hello and thank you for joining us today. So obviously, we have a lot on our minds here in the investment world, and I thought that a timely conversation about the markets would be helpful. We're going to be doing a number of these over the next few weeks, especially while things like this happen in the world and especially in the investment world. We want to keep you updated on everything, keep you updated with what's going on, and obviously, you always have a direct access with our team here to talk about your financial situation. As a financial advisor, I prepare for times like this. We're always preparing for times like this. So I want you to know that as concerning as it may be, flipping on the TV, seeing what's happening, seeing that the stock market's down, bond market's down, inflation is up, interest rates are rising. We do prepare for this. This is why we do financial planning with you. This is why we do financial planning for our clients, and we get to find out what your goals and objectives are for the future, so we can prepare, diversify your portfolio, and put you in a position where this is short term for us. These blips that happen in the markets, even though no one wants to see these, it's always something that is expected on our end. So, and obviously the worst thing to do during times like this is panic. And I know that's difficult for a lot of folks. You watch this, you see what's happening with the media, see what they're saying, but the world's not coming to an end. This is normal. This is normal in our world, and for the long-term plan with our clients, this is something that we expect. So I just want to let you know, once again, during times like this, you're going to hear a lot from us. You're going to hear a lot from us to reassure you that you're on track. And once again, going back to what we do for financial planning purposes, this is expected. This is what we expect going forward, these things to happen. And it's part of the cycle. It's part of the cycle that's been going on for 100 years here, and things will soon pass. And you'll hear me say that all the time. You'll hear me say that all the time. And also, we view times like this as opportunities. So whether you're currently accumulating and you're working, or whether you're retired, there's opportunities. There's opportunities, when we have times like this. So if you see us making changes, if you hear us making recommendations during times like this, it has to do with the opportunities. We don't want to do anything drastic, but we're always looking to try to take advantage of some things that have maybe been a little bit oversold, a little overdone. So today with us, we have a colleague from JPMorgan, Meera Pandit. She is a senior market strategist on the JPMorgan Asset Allocation and Asset Management Global Markets and Insights team. Meera is responsible for delivering timely market and economic insights, conducting research on the global economy and the markets, and also running economic forecasts. Meera joined JPMorgan in 2011 as an analyst in their private bank in New York, where she served high net worth clients. Meera has held business strategy roles in asset management in New York and London. Meera earned a BA in English from Tufts University and holds Series 7 and 63 licenses. She's also a CFA charter holder. Meera was also featured in MarketWatch's forecaster of the month in February 2020. So I want to turn the presentation over to Meera. That's going to talk, and she's going to talk a little bit about what's going on currently in the economic landscape that we have in front of us, what JPMorgan's outlook is for 2022, and also discuss some key drivers and trends that are taking place in the markets currently. So Meera, presentation is in your hands, please.
Great, thank you for your time today. I think your comments are very timely and well taken, and maybe I would add to that. We're seeing a lot of volatility in the markets, but why? Because 2021 felt very calm, very peaceful. 2022 feels pretty unnerving. And I think it's helpful to reset on where we've been and where we're going. So maybe the comment I'd make up front is 2021 was an unusual year of almost purely tailwinds. We had economic growth that was about 3 times stronger than we typically see. We had a consumer that was completely on a boil, spending well above pre-pandemic levels. We had robust earnings growth that was essentially 2 to 3 years worth of an earnings recovery in 1 year. And on top of all of that, we had ample support from the government and the Federal Reserve on the fiscal and monetary side when we think about accommodation. Now, because the economy was so strong last year, of course, the government and the Federal Reserve felt like this year we can reduce a lot of that accommodation that we've been seeing, pull back and allow the economy to kind of go its own way. So coming into this year, we knew we'd see a bit more volatility in markets because we actually now have a mix of headwinds and tailwinds. That accommodation is being taken away. That causes some degree of upset in markets. But again, it's precisely because the economy is strong enough to handle it. What we've also seen is certain things that have come up this year that we didn't expect. We've seen a resurgence of COVID in China that has caused lockdowns. We have seen this war between Russia and Ukraine. And both of those things put stress on prices and supply chains. So we've had some new headwinds here. But what I will say is, ultimately, economic growth is still solid. Everybody in America who wants a job can have one. We've seen that profits are continuing to grow this year. And ultimately, valuations, how cheap or expensive the market is, have reset. And things are looking a little bit more fair in terms of price. So I'll walk you through, some of the big drivers of why we actually still see opportunity in this environment, and we still feel good about the economy despite some of the challenges we're facing. And then again, some of the time-tested principles for how we operate in volatile markets like this. So if we take a look at the next slide, when I think about economic growth, obviously we look at GDP as a big measure, but I also really hone in on economic activity. What are people, what are consumers, what are businesses doing in the economy? How healthy is it based on activity levels? And we actually started looking at a variety of high frequency activity indicators at the beginning of the pandemic, because a lot of our traditional economic data just wouldn't update frequently enough for us to get a true sense of what was going on in the economy. So we started to look at, in gray, consumer debit and credit card transactions. That is essentially a proxy for broad consumer spending, whether it's goods or services. And then we've concentrated on some of the big service areas of the economy as well, because we are fundamentally a service-dominated economy. So we can see hotel reservations, restaurant reservations, airline travel traffic. And essentially these lines represent where we are today versus a pre-pandemic level. So you can see that there was a huge drop-off in activity in the early days of COVID, but then things have come back quite a bit. And if you look at those three service lines, we're seeing that things are more or less back to that pre-pandemic level, and services and travel have come back, especially when we look at spending and reservations, like roaring back more recently. So I think we're going to continue to see these lines move higher. What's even more interesting to me, though, is if you look at the goods and services component, if we look at spending overall, that actually recovered back in early 2021. So the consumer has been spending a lot. And despite a lot of the uncertainties we've been experiencing this year, geopolitically, from higher inflation, you're seeing that line is pretty steadily above pre-pandemic levels. Now, consumption overall makes up about 70% of our economy. So the engine of our economy is still humming, and that makes us pretty confident about economic growth. Now, we're probably going to grow at a more normal pace as opposed to 3 times as fast like we did last year. But that normal pace of about 2% is still healthy enough to keep us pretty far away from recession in 2022. So we don't think we're headed towards an economic recession this year. On the next slide, the labor market is also very healthy. Again, anybody in this country who wants a job can have one. In fact, anyone looking for a job right now has 2 job openings available to them. And so what we look at on this slide here is the unemployment rate in gray, which has fallen to about 3.6% most recently. And just to put that into context, there were only 5 other months back since 1969 where the unemployment rate has been quite that low. However, what that also means is we're actually dealing with some pretty meaningful labor shortages. So what that has been doing is pushing up wages. So you can see in that blue line, we look at wages today versus wages 1 year ago, and we've seen a pretty meaningful acceleration. Businesses have to offer more wages to bring people back off the sidelines and into work. And you can see that, we didn't see, based on kind of that slope of that blue line there, we didn't see a lot of wage growth over the last expansion, but certainly post-COVID, we have seen pretty meaningfully higher wages. Now, wages are important for a couple of reasons. One, we do think about them in terms of cost. They are a higher cost to businesses. They do eat into business profitability. So that is one thing we think about from an earnings perspective. But also, look, the worker is the consumer is the worker. We know the consumer is the engine of the US economy. So putting more money into the hands of the consumer does help demand, but it also can result in more demand than there is supply, which is going to push up prices. And I think that that's what we're seeing right now. So of course, the weak spot, the very obvious weak spot of the economy is the fact that inflation is very high. Not necessarily seeing a recession, seeing a strong consumer, seeing a strong labor market, but inflation is really the one piece of the puzzle that's not working for us right now. So if we look at the next slide, I think it's important to think, okay, then what is driving up inflation and where do we go from here? So what this slide looks at is essentially a common inflation measure, the most common one we look at to think about prices, the consumer price index. And each of these bars represents the year-over-year growth, March 2021 starting versus March 2020, so on and so forth. The final bar is March 2022 versus March 2021. So you can see how inflation has been accelerating over the course of time. Now, what we've also done is we've broken it down into what are the drivers of that headline number, what's pushing that up. And we've put it broadly into two buckets. And I think that's helpful for thinking about how inflation progresses and evolves from here. So we've used the terms transitory at the top to represent food, energy, things like new and used vehicle prices. That's broadly a measure of supply chains. And then also sticky. So that's goods, services, shelter. Now, those have become pretty controversial terms because inflation has clearly not been transitory and lasted a lot longer than expected. But I think it's helpful because transitory is essentially things that are a result of supply issues, and sticky are things that are likely to be a more permanent feature of inflation going forward. Another way of thinking about things is transitory is what the Fed cannot control through monetary policy and through raising rates. Sticky is what it potentially can. So that's really the area of prices that it's attacking. But I think it helps us understand that, look, things like food and energy prices are a little bit out of the purview of control, and we just have to kind of see how those continue to evolve. But I'll also say, if we think about where food and energy prices were at this time last year, of course, that year-over-year number is going to be a lot higher. Going forward, I don't think we're going to continue to see those increases in that level of a jump. So if inflation's above 8% today, I think it gets down to about 4.5% by the end of the year, and then into next year, kind of closer to 3%. So I think inflation is going to decelerate. But what is another important point is that, look, if something was $10 before the pandemic, it's not going back to $10. When we say that inflation is coming down, it's essentially slowing the pace of increases, but it's still increasing. So there has been a level set in prices, but at the same time, I think the jumps we're going to see here on out are going to start to come down. So we might be in the worst period of it now, but things are going to gradually improve. Now, of course, on the next slide, we don't need to feel helpless about it. The Federal Reserve does have some influence over those stickier categories through raising rates. So you can see the federal funds rate, that key benchmark policy rate over time on this slide. And more interestingly, perhaps, the expectations from the Fed in blue and the market in green of where it's going. And obviously, safe to say, rates are moving higher. And you can see already how some of this expectation and what's already gone on does impact inflation. I mean, for example, if we think about mortgage rates, they were at 3% coming into the year. Now they're over 5%. So that means this exuberance in the housing market is probably going to cool off a bit because all of a sudden financing costs have gone up. That is one way in which, clearly monetary policy does work. And that's how we anticipate things to kind of continue to evolve over the next couple of months. But I think the broader point here is rates are moving higher. While that will help rein in inflation, in the interim, it's also been a bit of a challenge for those of you invested in bonds. So if we take a look at the next slide, we can see, if you look all the way towards the right, just that impact we've seen year to date. So the blue line looks at the 10-year Treasury yield yield on the 10-year Treasury bond. And essentially, we've been in a positive environment for bonds for the last 40 years because yields have been falling. And when yields fall, bond prices move higher. And essentially, that means that people have had pretty good success in their bond allocations back since the 80s. And yet what we've seen this year is this sharp uptick in rates. And in fact, really historically, a really sharp move, not typically what we would experience in markets. And that has everything to do with the fact that the Fed, since November has gotten more and more and more aggressive on their plans to raise rates. And that has put upward pressure on yields overall. So we essentially saw the 10-year Treasury yield go from 1.5% to about 3%. Again, steep, sharp move. And so what you've experienced in your portfolios then is yields moving up, bond prices going down. It has been one of the worst starts to the year for the bond market in decades. So what you're experiencing right now is acutely painful in the context of history. Maybe the good news, though, is the Fed is planning to move very quickly. It's already moved very quickly. So we go very quickly from a period where the Fed is just starting to tighten monetary policy to it has done a lot of the tightening that it's going to do. And I think what that means is that yields start to stabilize in the back half of the year, which means you're starting to get some more income from your bonds. But over time, it's also going to provide more and more downside protection, unlike what we've seen over the last quarter when we've seen a sharp move higher in rates. So as they stabilize, I think those bond allocations are going to start to be a little bit more useful in terms of providing income, but also providing some of that downside protection as risks, continue to materialize. On the next slide, if we think about the equity market, people have, of course, been very happy with what the equity market has done over the last 2 years, with the last couple of months of 2022 excluded, because returns are amazing. And yet, the whole time people were saying, okay, but we're nervous about valuations, basically how cheap or expensive stocks are. And this slide here looks at that over time, how cheap or expensive stocks are. You can see that 25-year average and where we are today. And for a while, post-pandemic, we were in an environment where valuations were very high. And that does make them vulnerable to correction because it means it's kind of pricing in the best case scenario. And certainly what we've seen is that correction has come to bear. So while it's been a painful ride down, at the same time now stocks are essentially fairly valued, a reset that we've been thinking through for a long time. But it's not just because the stock market has fallen. That if you think about what this measure is it's price over earnings. So prices have come down, but it also highlights the fact that earnings have come up. And that's also been something that has reset valuations and that stocks have been allowed to kind of grow into those valuations with better earnings. So if we take a look at the next slide, let's take a look at the left-hand chart. We look at the dollar value of earnings per share over time. And what we did last year is we started to shade in some of the bars in green just to say this is an earnings recession. So the peak in earnings in a dollar value has not been surpassed. So it's kind of the time where things are still recovering and earnings growth is falling. And I think what's remarkable about what we've just experienced is you can see a single green bar in 2020 for that earnings recession. And then you can see a massive jump to that next gray bar, that one single gray bar in between the green and the blue. That represents 2021, where we essentially therefore had 2 to 3 years worth of recovery and profits crammed into one. We had 70% earnings growth last year, when in a typical year you might have 6, 7, 8%. The good news is as we look at the expectations for earnings going forward in 23, in 24, in 25, in 22, 23, 24, in those blue bars, you can see that, look, you're still stepping up, profits are still growing. They're just going to grow more slowly. So what that means is, last year you could be invested in any year of the market. Profits did fantastically well. Your performance was probably fantastic. But this year, there's going to be a smaller number of winners, a larger number of losers. So we have to be a lot more selective about where we're investing in the equity market. And our allocations really have to hinge on going into stocks that actually do have a a pretty good profits outlook. On the next slide, I'd also say when we think about sentiment right now, we've seen that valuation roll over. People are feeling bad about inflation. People are feeling bad about the markets, Russia, Ukraine, China, you name it. But I would say don't use how you feel about the current environment as a guide for how you should invest. Because what we've seen over time is that it's often darkest before dawn, and some of the best times to invest are actually when things feel really rotten. Now, maybe the exception to that would be if we're going into recession. But remember, our base case is that we're not going into recession this year because of consumer health, labor market health, housing market health, a number of different areas of the profit health, a number of areas across the economy that still look good. So what we look at to illustrate that point on this slide here is we look at consumer confidence. This is a sentiment index on how the consumer is feeling. And we've also looked at, okay, what are the market returns 12 months after sentiment is at a peak and 12 months after the sentiment bottoms. So we go back to 1970, we look at the 8 peaks and the 8 bottoms that we've experienced since then. And what you can see on average is that the 1-year return after sentiment peaks is about 4%. The 1-year return after sentiment bottoms, when we are at the lowest, is 25%. So I'm not trying to call the bottom of the market here and guarantee that things are going to go up from here. But what I am saying is that certainly how we feel is not always a good guide for how we should invest. On the next slide, again, volatility has come back with a vengeance this year, but let's put it into perspective. What this slide looks at is the calendar year return on the S&P 500 equity index. And also in red, those dots show the maximum the market fell in a given year. And on average, over this time period, the market falls about 14% every year. So if we look all the way to the right, last year, the market only fell 5%. Very unusual. And remember, we had all of those different tailwinds between accommodation, growth, consumer, earnings, everything looked really rosy. So we had a 27% return with only a 5% drop at some point in the year. This year, we're kind of closer to about 16, 17% in that drop in the market. And that has been very painful, but at the same time, somewhat more in line with what we've tended to see in the past on average. So this is more of a typical investor experience, even if it doesn't feel like that, because it feels uncomfortable and we feel out of practice with volatility given what happened last year. What I'd also point out, though, is, and John said this up front, we always know that we're going to see volatility. I mean, look at that 14% drop every year on average. We know that. We don't know when it's going to come. We don't know why it's going to come. But since we know that it will come at some point, we try to behave in our portfolios in a way that takes that into account. And that's why we diversify portfolios. That's why we operate with a long-term time horizon. Your investment plan takes into account that we're going to see these 14% drops. And ultimately, for investors who are patient and ride it out, they're often rewarded. Because what you can also see here is in 32 out of the last 42 calendar years, we had positive returns. Again, not trying to say we're going to definitely be positive this year, not trying to call a market bottom, but what I want to reiterate is the fact that the S&P 500 has never failed to regain a prior peak and then surpass it. So we have a pretty good track record as long as we are patient with some of these periods of turmoil. On the next slide, this just reiterates that point about patience and diversification and essentially illustrates that working in effect. So what we can see on this slide here is stock in green, bond in blue, and 50-50 stock bond portfolio returns in gray over a 1, 5, 10, and 20-year rolling period, going all the way back to 1950. And what you can see here is, for example, if you were invested in the stock market in green for just 1 year, you could have a 47% return. But you could also have a negative 39% return. So a massive range in outcomes there. But as you take on a longer time horizon, you can see that that range of outcomes compresses meaningfully and also overwhelmingly skews positive. What you'll also see is that if you just add a bit of bonds to that to help protect on the downside and gear towards that 50-50 diversified portfolio, that diversified portfolio does not experience a calendar year negative period of 5, 10, or 20-year rolling returns. So it does help to protect on the downside, capture returns on the upside, and deliver that smoother ride so that when you're looking at your statement month after month, you're not seeing wild swings in the dollar value. And hopefully that'll help you to stay invested, because the secret killer to portfolios is not volatility, but it's trying to time the market and get in and out of the market, because often then you miss out on some of the periods of rebound. And again, the silent killer of portfolios is not volatility. It's not being invested long enough to actually meet your investment goal to be able to pay for retirement, college, new house, whatever it might be. So it's really about time in the market as opposed to timing the market. I think that was my last slide in there. So I will stop there, and I'm happy to answer any questions or address any other topics.